Hey everyone, welcome to today's video. So on this video, I'm going to consolidate some of the key macroeconomic changes which are happening in the year 2025. For example, US dollar is depreciating. So what impact is it going to have on the stock markets? Similarly, India is trying to strengthen the BRICS currency and BRICS organization. So what impact is it going to have? So series of macroeconomic changes are happening right from AI. Now people are saying that it will become the next dot-com bubble. So that's again a macro change which is happening. So I'm going to consolidate all these macro changes on this particular video so that you can make investment oriented decisions. The key takeaway of this video would be that it will give you clarity whether or not you should be saving cash right now, because people are forecasting that 2026 is going to be a crash year. That is where mother of all crashes is going to come due to increased debt and bunch of macro changes. So I'm going to help you understand the gravity of this, right, and give you clarity on this topic. So, okay, so let's jump right in. And first and foremost, why people are saying that 2026 is going to be mother of all crashes here is because of this banner chart, right? So Samuel Banner was a person who gave like 100 years of stock market forecast. And guess what? He has been fairly right? And in these 100 years, he has predicted almost every crash. But this chart has been fairly accurate, right? So 1945 is where the World War II ended, right? Around that time. So this was the peak of destruction, so to say, right? Because the world started rebuilding in this year. 1999, we had dot-com crash. 2019 and start of 2020, we had COVID. So this was the peak panic years, right? His recommendation is that people should sell their assets in these mid years, right? So for example, if you would have sold your assets in 2007, you would have avoided the crash, okay? Similarly, if you would have sold your assets in 1999, you would have avoided the dot-com crash. So except for 2020, right, he has been fairly right from this period on. And he is predicting that, hey, next great time to be selling all your equities is 2026. So essentially, he is predicting kind of a bubble burst in 2026. Well, is this going to happen? Is this not going to happen? Is this just some kind of weird astrology or whatever? Let us go through economics in order to understand this more, okay? So there are 5 or 6 key things or macro events that are rolling out in front of us. So let me go into the details of this and let me help you understand why there might be a bubble and whether or not the bubble will crash because of these events. Okay, so since we are speaking about bubble popping in the finance market, it's also important to understand that a lot of bubbles are popping in the job market also. The job market is changing dramatically. A lot of people are unfortunately losing their jobs. And one way of growing in your career is to upskill yourself and stay updated with relevant skills like artificial intelligence. The professionals who understand how to use artificial intelligence will see compounding advantages in their career. So therefore, I would recommend you joining an exclusive 2-day AI training workshop, which is happening live over Saturday and Sunday, 10 a.m. to 7 p.m. IST. Normally, this is priced at 10,000 INR, but for my viewers, it is completely free of cost. Thanks to our partners for today, which is Outskill. This is the world's first AI-focused education platform backed by leading AI founders and investors. In 16 hours of live training, you will understand about building a personal AI toolkit of 10 plus tools, mastering prompt engineering, automating workflows and analyzing data without coding, creating polished presentations, visuals, and faster reports, developing AI agents, tools to support decision-making process. More than 1 lakh professionals have already undergone this training and have seen the benefits in their career. The seats are limited, so if you are committed to future-proofing your skill set and maximizing your professional ROI, this is a smart investment you can make and it's free. Please click on the links in the description and comment box, and also don't forget to sign up for their WhatsApp group. So the first key thing that people are predicting is the fact that AI has become overhyped. For example, if you consider Nvidia stock here, it has gone 60 times in the last 6 years. This is massive, right? So of course you will say that Nvidia represents like artificial intelligence. So yes, artificial intelligence, so much like, bubble is getting formed. Everyone is running after AI stocks. Everyone is investing in like AI companies. So yes, it's a bubble, right? And it will pop, right? And most likely it is going to pop in 2026. So is this really true, right? And the corollary that they give is the 1999 dot-com crash. So people are saying that, hey, because in 1999, there was another kind of a tech bubble. 2025, we are again sitting on like AI bubble, which is again a tech driven thing. So something similar fate is going to be met for AI also. So, okay, here is like data that I had digged. I had done a tweet also on this topic. So I'll just quickly take you through it. And this is especially important if you're investing in AI driven companies. So AI right now is growing at 25% CAGR. Now this is absolutely true that there is horizontal AI, which is foundational AI, and vertical AI companies that are getting built, right? So right now in 2025, a lot of money is being poured by VCs into AI-based companies. This has similar feature what was there in the dot-com crash also, that during dot-com crash also VCs invested ton of money. Then governments were funding a bunch of projects in dot-com. Something similar is happening. Maybe it's not happening in India, but in China, US, that is happening. Businesses were pivoting to dot-com in the dot-com bubble thing, and same is happening with AI. But see, what's happening and the key difference between the 1999 dot-com bubble and the current AI is that in AI, demand is ahead of supply. Now, what is the meaning of this, right? So let me quickly take you through the reason why dot-com bubble burst. It happened not because of dot-com companies. It actually happened because a lot of pointless supply was built, which was never used, right? And this was done by telecom companies. Telecom companies were betting on the fact that a lot of internet-based companies will get built right by early 2000s, and they will have to use telecom in order to move data from point A to point B. So it started laying down a lot of fiber optic cables, and the capacity expanded so much, and that capacity was never filled, right? So this was called as the dark fiber phase, right? So here is the complete paragraph that I had written on this topic, that telecom companies had raised almost $2 trillion in equity and $600 billion in debt. And this was the total outlay of money that had happened during the dot-com bubble crash, and this capacity was never used. Now, what is happening in AI is opposite, that the demand is way too high compared to supply. Now, let's pick the example of NVIDIA itself, that the demand for the Blackwell processor is so high that NVIDIA recently decided, in fact today, they decided that they are going to increase the price of their NVIDIA new chips by 15%. Why 15%? Because Trump had put 15% tariff on NVIDIA, which NVIDIA now plans to extract from their customers. You can only do that when there is a severe shortage of supply, right? So I don't think that in 2026, any kind of crash is coming due to AI correcting, right? So this is point one. I will say that, okay, this is just your opinion. Can you back it up with more data? So, okay, so then let's start discussing the second key bubble. The second key bubble is called as the earnings bubble, right? Now this forms from time to time in the stock market. So let me quickly explain the meaning of earning bubble, right? So for example, you would have heard of something called as PE ratio. Now in PE, E का मतलब होता है earnings, right? Earnings. Now, if let's say, and this is the situation in 2025. Now in 2026, if the earnings of companies grow, then what will happen to PE ratio? Well, PE ratio will come down, right? That's what mathematics tells us. So it's more of an earning problem. That's what I'm getting at, that if there is an earnings slowdown, then yes, a bubble can pop, right? So this is an important point to analyze, that, okay, in 2026, is there going to be an earnings slowdown? Now, when the year 2025 started, Donald Trump went and put tariffs on the world, right? And we saw like a 20% correction in the US stock market also. Now, that is where I went and purchased significant amount of dips in the market. And right now, my portfolio is doing exceptionally well. It beats 99% of mutual funds in India. Why? Because you have to always intelligently time the market. This is what I teach to my students also. I am not a proponent of SIP. I don't think it's going to make you any crazy money. Even Warren Buffett intelligently times the market. And you have to put in the hours in terms of learning investing. So in case you are interested in following this portfolio, in becoming a member of Wisdom Hatch, the company that I run, and being a profitable investor, definitely do consider checking out my courses. I will link it in the description comment box. You'll have a fabulous learning experience. The community has been deeply happy. I'm building more portfolios. I'm building an AI first portfolio next. So in case you want access to all those portfolios, definitely check out the links in the description comment box. Okay, so back to analyzing the second bubble. Let's see, in 2025, Trump put tariff and there was a 20% immediate drop. But here is the NASDAQ or QQQ chart. It went down, it went back up, and now it has even cut its previous high. Okay, so what has happened is that this recovery came in really fast. Now, why am I relating it to PE ratio, right? Because everyone was expecting at the start of 2025 that, hey, Trump had put tariff. This is going to lead to a slowdown in 2026 and the earning bubble is going to pop. But unfortunately, 6 months into 2025, investors started to realize, or analysts started to realize that, hey, this tariff war is not so bad for the world economy. Why is that the case? That's a separate video altogether. But the tariff war did not have the kind of impact that investors were anticipating. So as a result, now the updated view is that in 2026, earnings are not going to shrink dramatically, or at least it will not shrink dramatically to the extent that investors thought. And as a result, this recovery that had happened recently is factoring in all those points. You have to study it in context of interest rate cuts. For example, recently you would have been hearing that Donald Trump keeps on bashing his RBI governor, so to say, or an equivalent there, Fed chair, that he's not cutting rates and all that. So he's pushing him, right? So by 2026, it's expected that interest rate cuts will kind of mellow out and will give earnings a push, right? Now, let me put all these data points through this slide. For example, economic growth in the US is projected to modestly improve from 1.6 to 1.7. So 2026 is going to be slightly better year. Monetary policy is expected to ease, which means interest rates are going to get cut, which again helps the stock market. Some caution is exerted, that is always the case. But in summary, while risks and uncertainties exist, the consensus forecast from sources such as Bloomberg show corporate earnings recovery and growth in 2026 rather than a slowdown. So again, earnings slowdown doesn't seem like the reason for a bubble pop. So then let's move to point number 3. But just before that, I just wanted to show you another key data point, which has to do with segmental part of the economy, that in which sectors there is going to be earnings improvement, right? And why is it that I'm building an AI first portfolio? So if you take a look at any of these sectors, these are the sectors where earnings improvement in 2026 is likely to happen. So I'm buying these stocks now, right? And I have already built heavy positions in it, including some of the healthcare and biotech stocks. I feel this is an undervalued sector in the US right now. I'm currently buying a lot of stocks from that segment and would buy even more over this month and the next probably. So these sectors are actually going to show massive earnings improvement in 2026. So just wanted to give a note, and let's now analyze reason number 3. Okay. So the third key reason that people are pointing to is that, hey, here is the US debt chart, that US has just gone haywire in terms of taking debt. It has trillions and trillions dollars of debt. They will be repaying in terms of interest $1 trillion in debt every year. Great. Okay, and here is something very, very interesting I will tell you, and if you find this information to be useful, definitely do subscribe to the channel, because I am going to make more videos on these type of topics which are less discussed. Okay, so let me start the story that what is the meaning of debt. Okay, so let's say that US right now has roughly $30 trillion of debt. Okay, so let's assume that. Now let me quickly explain that why this debt, such high levels of debt is not really dangerous for the US. See, whenever you are analyzing debt, you have to analyze it in context of assets. For example, if you just study in isolation that Adani ji has 200 crores of debt, does it matter? No, right? Why? Because he might have a lot of assets, right? Versus if Akshat has 2 crores of debt, now that 2 crores of debt might be very dangerous to me because I might not have that many assets. So you have to see debt in context of assets, right? And one of the key assets that we keep missing in the US is gold. Now here is US's gold reserves in tons. And for comparison, I'm putting China and India also. So US has 8133 tons of gold. So when people say that India has the most amount of gold, no. Or China has the most amount of gold, no. It's the US, okay. And this is the gold reserve. Now estimated value of gold is $888 billion, right, for the US. Now you'll say, okay, great. This is already accounted for. No, in US there is a special law, right, which dictates how the US government can value gold on its balance sheet. So this is the law, right? And the US values its gold reserve on its balance sheet at a historic book value set by law, which is at $42.2022. And this price was established in 1973. Now, since 1973 to now, the price of gold has gone up manyfold. But US on its balance sheet is not revaluing this, right? Now, if Donald Trump decides to revalue this, what is going to happen to the debt? Debt is going to come down in a way, right? Or US can revalue and pay a part of that through gold. So this is the important point that people miss. And it has been written that US Treasury hold 261 million ounces of gold. This has approximately at $11 billion ki accounting hai, but this is over $750 billion. In fact, it's $888.6 billion as of today. So there has been a massive discrepancy in terms of the US owning its asset. So yes, debt is a problem, but US right now is in a position to very well repay that debt, right? So again, debt collapse is unlikely to be a reason that US is going to default on the debt or something bad is going to happen to the US, because US has a lot more tricks up its sleeve. It can revalue gold. It is trying to do something similar to Bitcoin, that it is aggregating a lot of Bitcoin and it will revalue Bitcoin at a certain stage and offset a part of its debt via that. Okay, so then the next bubble pop comes from the theory that, okay, US dollar is going to decline and it's going to die and US dollar dominance is going down. So, okay, so I'll just quickly show you a chart. So US dollar prominence can be assessed through a chart called as DXY. So this is called as dollar index, right? Now it indicates the strength of US dollar compared to other prominent currencies, and it has been plotted on an index called as DXY. Now you will see that index is trading somewhere here. Has it fallen? Yes. But is it at an all-time low? No, this was there here also, right? This was the consolidation zone. This has happened multiple times in the past. So let me show that to you also. For example, here, right? So it has happened multiple times in history. So this is not the first time that the strength of US dollar is going down, right? So it is not as if that it will just decline like this, right? So this is one point. Second key point is that if you replace the US dollar, you have to replace it with something, right? For example, what are the prominent options right now? One is gold, that everyone starts trading on gold. But in 1970s, we moved away from gold to money printing, to some other government currency. Now, if the world suddenly starts trading in gold, it's very difficult to trade. There was a reason why we moved away from gold to a fiat currency, like INR, Singapore dollars, etc. Then you will say, okay, fine, maybe like Chinese currency will replace. Would you trust China, right? Or would you trust US more? Right now, Mahal is such that, okay, you'll say, no, US is bad, this, that stuff. But China, do you trust, right? We fought a war with China, right, in the past. Have we fought such wars with the US? No. People forget history like whenever it's convenient. So, okay, will you trust China to become the apex currency in the world? No. Will you trust China to become like the apex currency in BRICS? Do you think that really good for India? Again, no, it's not, right? So whom would you give that power to, right? So this is a natural question, that it sounds great that US dollar will fall, but with what will it get replaced? That's the most important bit. And as I explained, that US dollar will only fall when US is out of power, or when US is not trading enough, or when US does not have enough clout. Definitely over 50, 60 years, 70 years, the dominance will come down. But honestly, post like 2000s, US dominance has been coming down. It's coming down slowly, right? So it's not going to be like a crash which will happen in the next 2-3 years, okay? So this is another key point. Okay, so then the next theory comes that maybe China will do something to the US that will make US collapse. For example, China holds a lot of US treasury and it will sell those treasury. And then suddenly US will go bankrupt. So this is like an economic theory that keeps floating around. So here is China's US treasury holding in $1 billion. Okay. So you'll see that it used to hold like maybe $60 billion worth in the year 2000. It went all the way till 1300. From 2013, it has been cutting. And now it has stabilized somewhere around like $800 billion, right? Okay, so let's analyze this in terms of numbers. So the total size of the US Treasury market, or the total outstanding bonds by the US government, is approximately $37 trillion. Now, out of that, $800 billion is held by China. So in percentage terms, this is less than maybe like 3%. Okay. Now, if 3% of some stock or some bond is sold, do you really think that that asset class will crash? Short answer is again no. So again, China cannot crash the US Treasury market or make US default, because it starts to demand payments. Moreover, these treasuries are time dated. Time dated means that, for example, when you do FD, some FDs mature in 1 month, some FDs mature in like 6 months, then 1 year, then 5 years. So even from a time span point of view, these are not immediate treasuries that are maturing and China can demand payment, right? So again, this will not be a reason for imminent collapse. So then comes the next point that, okay, maybe there is some fissures in the employment market, that people will not have enough employment. True that employment situation has been bad, right? Especially wage growth has been really bad. That can lead to a revolution. This is a possible scenario that will happen, but governments are already working on it. For example, Indian government is now running the largest social benefit program that we have ever seen. US government is doing the same. European governments are doing the same. So what they are doing? Well, they are creating a variant of universal basic income. Ki free mein mixer grinder le lo, free petrol le lo, free food le lo, right? Whatever it is, they will give you free, right? So revolution does not happen. So again, this would not be a reason for a bubble. So long story short, if we analyze any major macro thing which is happening around the world, except for a war as of now, or like an hidden crisis. For example, in 2020, world was shaken with COVID. No one expected COVID. Unless we have those type of events, it's unlikely that there is going to be a dramatic shock to the stock market. So what does this mean to you, right, in terms of summary? So point number one is that you should do 80-20. 80-20 means that at least 70-80% of investment should go to the market. 20% you can sit on cash because the markets are relatively expensive right now, and they will remain expensive rather till the time there is potential for earnings to grow, right? So this is a very important point. Point number two is that you have to invest in the right segments because of something called as power laws. For example, if you combine the net profits of top 7 US based companies, it will come out to be more than 50%, right? Out of 500 companies in the US, top 7 companies are generating 50% profits. Okay, so this is power laws, that money is going to monopolies. So you should invest money in superior markets, which according to me is the US, right? This is 2. I'm not saying that do not invest money in India. India is a good market, but it's a value play. For example, right now IT stocks are at a discount. Buy those. Nifty is at a reasonable level. Okay, fine, that's a technical play. But India is a buy and sell type of a trading market. US is a buy and hold type of a market. So please remember that. This third key point, there has been a structural slowdown of growth. None of the economies are growing really fast, including India, including the US, etc. That is a problem, but certain pockets of the economy are growing really fast. So our job as investors is to identify those pockets and move our money into industries that will grow fast. So those would become our buy and hold. So yeah, so that's the message, that do not be scared of investing. Is a mother of crisis coming? I don't know. Or bubble is going to burst? I don't know, to be honest. It doesn't look like, at least studying the macroeconomics. All the data points I have taken through. Now it's your wish how you want to play this. Do check out the sections in the comment and description box. I'll link some more videos for your knowledge, and I'll see you soon. Thank you so much.